Welcome to the Norris Group Real Estate Podcast, a show committed to bringing you insights from thought leaders shaping the real estate industry. In each episode, we'll dive into conversations with industry experts and local insiders, all aimed at helping you thrive in an ever-changing real estate market, continuing the legacy that Bruce Norris created, sharing valuable knowledge, and empowering you on your real estate journey. Whether you're a seasoned pro or a newcomer, this is your go-to source for insider tips, market trends, and success strategies. Here's your host, Craig Evans.
Welcome, everyone, to the Norris Group Real Estate Podcast. We have a couple of tremendous guests, some old friends of ours, Matt and Han from Keystone CPA. Matt received his accounting degree from UCLA and a master's in taxation degree from USC. As a CPA, Matt brings over 2 decades of tax planning expertise in working specifically with real estate investors and high net worth individuals with his experience in Big Four public accounting and in private client advisory. Matt is an avid speaker and educator on real estate tax strategies and authored the book on advanced tax strategies for real estate investors. Matt has a passion for animals and founded the Animals for Armed Forces Foundation. In his spare time, Matt loves all things baseball, coaching Little League for his sons, watching baseball on TV, going to a local game, or just talking baseball with anyone who will listen. Amanda received her accounting degree from UNLV. As a CPA and real estate investor, Amanda has helped countless investors across the nation supercharge their wealth building through proactive tax savings with her top-selling Amazon books, as well as her teachings on prominent publications such as Money Magazine, Google Talks, and CNBC. Amanda brings over 2 decades of tax planning and compliance experience from working in Big Four public accounting as well as public and private companies. In her spare time, Amanda enjoys canvas painting, biking by the beach, and seeking out the best hole-in-the-wall dining options wherever she visits. Let's welcome Matt and Amanda. All right, welcome everybody to the Norris Group Real Estate Podcast. We have some friends of ours. I don't want to say old, because when you say old friends, like people are like, hey, I'm not that old. They've been friends of the Norris Group for a long time. That's
long time.
Let me frame it that way. So today we have Matt and Amanda, of course. Thank you so much for joining us, guys.
Yeah, I'm excited to be here.
Oh, thanks for having us, George. Good to see you.
All right. So, there might be some folks that are brand new to our audience, and it's been a couple of years since you guys have been on a podcast or been at our event. So, for the benefit of those that are living under a rock, can you tell us what Keystone CPA does and who you guys primarily work with?
Yeah, well, again, thanks for having us. I'm from Keystone CPA. We specialize in working with real estate investors all over the country. We help them to proactively plan to save on taxes and use that tax savings to help continue building their wealth.
Yep. I think most people come to us are folks who own real estate or plan to own real estate, but don't have a CPA who helps them to plan strategically on how to use real estate to not just build wealth, but also save on taxes. And I think it's no secret that the tax law favors real estate investors. But the key missing ingredient that we see is just people not really understanding how to actually implement some of those strategies to take advantage of the tax code. So we have a passion in sharing what those things are and educating people on how they can do the same.
And as you stated, we are old, so we've been doing this a long time. So,
well, see, that was one of the things by pre-recording your bio. I didn't have to sit there and say over 2 decades of experience.
Right.
So, anyways, so what? Say somebody starts, hires Keystone CPAs, talking to you guys. What is what is the biggest thing that they find out that they've been missing?
Mm-hmm. Gosh, there's so many different things, and the findings will differ from person to person. But what's really interesting is that based on our experience, when we start doing tax planning for a client, the first thing we do is look at the previous year's tax returns, right? Whether it's business, personal, real estate. And that's important because it gives us a good understanding of what they've done in the past, what they own, but kind of just the overall detail of their finances. But the interesting thing is that over 40% of tax returns we review are not optimized for tax savings. So pretty high percentage, and it is from a lot of different things. maybe not capturing expenses, maybe not being in the right legal entities, sometimes not optimizing depreciation, right? So a lot of different reasons as to why tax returns not optimized.
I think from my end, the one that comes to my mind is that I think a lot of people they haven't done tax planning in the past. So a lot of people think that, well, I've hired this CPA, this tax preparer, whoever, they're filing my returns, they're helping me do tax planning, right? Obviously, because they know my numbers. But in reality, what they're doing is, we all know they're doing is they're just filing your returns and putting numbers on a form and representing what's already happened in the past. They're not actually helping you what's going forward. And so that's what we like to do, is we like to meet with clients and, hey, what are your goals? What are you trying to do? What can we put in place to help you save on taxes this year, coming forward, next year after that kind of thing.
That's the big proactive piece, right?
Right, for sure.
Yeah, we all file tax returns, but I think the majority of Americans, including investors, don't actually do planning separately outside of, let me get my tax returns filed.
Yeah, we're going to dive into all of that a little bit later. But before we get into that, I want to just touch a little bit more about your background. So one of the big questions that maybe, what is Big Four accounting?
So Big Four accounting is, it's Big Six, I think, when I started, but Big Eight, I don't know. But it's the large multi kind of national CPA firms that work with clients all over the country. It's just the largest 4 CPA firms out there. So that's where we got our start at one of those. Great experience out of college. Obviously, you get exposed to a lot of different industries and a lot of different types of taxpayers and things like that.
So what was it about working with real estate investors either made you guys pivot or drew you to working with real estate investors?
It's actually interesting because it's actually not that experience. So when we were working in one of the Big Four firms, I was in the real estate specialty group and Matt was in the high net worth individual group. And all that means is, I worked on a lot of the largest real estate investment companies. And then he worked on the individuals who were part owners of those. But doing that day in and day out didn't really lead us to want to invest in real estate. I think, like many people, we were always of the thought that real estate was for people who are really wealthy. Tax savings was really for the people who were wealthy. So for many years, we see the tax savings, we know the strategies, but we always thought those didn't apply to us. They applied to our clients, but never to us. And it wasn't until we read Robert Kiyosaki's book, Rich Dad, Poor Dad, when we thought, what? That's stuff that average person can do. And so maybe that's something we can do as well for our own wealth building.
So
I think for me,
yeah, go ahead.
I was going to say, I think for me, the big kind of, I call it the aha moment, was when I was working the Big Four firm. I was probably a couple years in, and I was working on reviewing an individual's tax return. He was in his 60s at that time and making over 6 figures in cash flow on his real estate, but not paying any taxes. And so that's when the light bulb went off. It's like, hey, there's something here. Like,
let me get some of
this
that.
This guy's clearing hundreds of thousands of dollars and not paying any income taxes. Like, so that's kind of when the light bulb went off, and it was it just, again, something we like and understand.
So you guys both come from those Big Four companies. Like, what made you guys say, all right, let's take a leap. Let's start our own firm. How did Keystone CPA come about?
It's actually interesting. When we first started getting interest in real estate, we didn't know how to invest in real estate. We knew the tax strategies. We didn't know how to analyze deal. We didn't know where to find a good property. So we started going to a lot of real estate investment clubs locally. And that's where we met everyday investors. And what we found out was that everyday investors didn't actually do tax planning. All of the stuff that we're so used to doing at our day job was not available to regular folks who invest in real estate. So that's what sparked our passion originally, in that we wanted to bring those same strategies down to everyday investors to be able to do the same, basically take advantage of the tax code to leverage tax savings from owning rental real estate.
So clearly you guys both have, all the credentials. People think that, you become a CPA, like, I'm just a CPA for life. One of the reasons we weren't able to, schedule this podcast for a while is because you guys are constantly having to learn. So as a CPA, you never stop learning because of all those changes, and what does it take to stay current as a CPA?
You're right. I mean, it definitely changes all the time. I mean, obviously with, when you change administrations, you change government, it's, new tax law comes out. There's those things to consider. But just as a CPA in general, we do have to get 80 continuing education hours every 2 years in the state of California is where we are. So that's important there. But we were talking earlier, right, with offline, AI, the whole industry is changing everywhere. And so being able to stay on top of that, what's changing in the CPA industry because of that, what are some new software that people are using? What are some new processes people
I got
are using?
a whole segment about that.
A business perspective, right? You got to stay on top of that. So it's a lot of stuff, but it keeps us on our toes for sure.
What is the biggest thing that other CPAs struggle with that you're finding that like there's a reason why these people came to you?
Well, what's really interesting is that everybody gets their tax returns filed, but not many people actually do tax planning. That's from the taxpayer side. But when we go over to the CPA side, most CPAs file tax returns. That is what they deem to be their job. That's what clients hire them to do because the need is to file tax returns. Very few CPAs focus on tax planning. The reality is that, especially with AI, there are not a lot of people who are graduating now who want to become an accountant because there's a huge fear that AI is taking over the job of accountants, or one of those that's easily replaceable, theoretically. And so you have a large population of people who are retiring, so taking them out of the workforce, and then now no additional folks coming to become CPAs. So the pool of CPAs are much smaller. So you have fewer CPAs to service all the tax return filing, which means even less time for a CPA to even think about tax planning for a specific client because you're just back to back with filing tax returns. And that's the reason the majority of people come to us, not because they need a tax return file. They still do need someone to file it, but it's mainly, hey, my CPA does not have time, knowledge, or ability to give me tax strategy. So please help me out with at least the planning side of it.
Yeah, and along those lines, I think it's the specialty aspect as well. A lot of CPAs, tax preparers, whatever you want to call them.
It's like assembly line, right? Just like
they're a generalist, right? They file all kinds of tax returns, and we learned early on that, hey, real estate is something we understand. It's something we know. It's something we are passionate about. It's something we're good at. Let's focus on that. We don't file manufacturers' tax returns. We don't file retail companies' tax returns. I'm sure we could figure it out, but I don't know what I don't know, and I'd rather focus my energy on the stuff that I know.
So what are some of those telltale signs, or let's say red flags? Let's say I have a CPA, but what can working with him or her tell me that maybe my CPA isn't optimizing for my career and it's just giving me that general file?
Well, I think the first question would be, how frequently do you meet with your CPA?
That's a great point.
Another question to ask yourself is, what is my plan? Can I describe, if you were talking to me, can you tell me what is your tax saving strategy? Is it buying rentals? And what is our exit strategy with respect to my portfolio? How am I passing it on to the next generation? Am I eventually going to sell? Is my husband or wife going to take over if something happens to me? And I think another sign to look out for is whether you're someone who always has to explain your transactions to your accountant. Real estate investors, we don't feel it a lot, but there's a whole real estate lingo that we always talk in. And I think a lot of people find it frustrating when they talk to their accountant, not even just on the strategies, but taking a long time to explain and teach them what exactly they're doing in real estate and how they're currently structured. That's a sign of somebody who doesn't really understand real estate as a business.
Another way to look at it is we like to joke, but it's true, is that is your accountant talking to you more about what you can't do versus what you can do?
Oh.
So if you want to spend more time about what can I do, let's talk to somebody who is proactive and thinking of the future versus, most people, they're looking at what you can't do, right?
Without getting into the whole AI piece, because I have a whole segment about that for you guys. What is the biggest tax law changes that investors should be looking for this year?
Well, there's several very major tax changes that came out of the One Big Beautiful Bill in July of 2025. And what's really great about that is most of the changes were retroactive, meaning available for the 2025 year, which are the tax returns people are now filing, as well as going forward for 2026. A couple of big ones with respect to real estate investors or real estate in general is we have the ability to exclude potentially up to 20% of real estate income from taxes under qualified business income deduction. That's not brand new, but the One Big Beautiful Bill allowed us to continue to have that tax benefit. So very helpful for landlords because it is available for certain rental income. Realtors on commissions income, property management income, also eligible for development, flipping, wholesaling. Most of those real estate related income could be eligible. The easiest way to explain it is if you have $100 worth of taxable rental income, maybe you only pay taxes on $80 of it because $20 of it potentially tax-free under qualified business income deduction.
Another one that, again, it's not brand new under the One Big Beautiful Bill, but was extended and continued forward is the pass-through entity tax break. So anybody that's got, a lot of your listeners have realtors, right? They have a real estate business or wholesaling, fix and flip, something like that. If your entity is profitable and you are paying state income taxes at the personal level, you should be looking at having your entity pay those state taxes on your behalf instead of you paying them with personal funds. The benefit is now we can take a full deduction for it at the IRS level, whereas if you pay it with personal funds, a lot of times that deduction is going to be limited. So it's a nice thing that, again, it's been around for 5, 6, 7 years, and it's been made permanent under One Big Beautiful Bill, but believe it or not, we still see it all the time that people are not taking advantage of this.
A very big benefit for California folks because California state taxes is so high, and effectively what we're doing is we're turning a personal expense into a legitimate business deduction by having the business pay for it. And the last one I would say for real estate, more real estate specific, obviously 100% bonus depreciation.
Yeah, I was going to ask, what's happening with bonus depreciation? Everybody wants to hear about it.
It's really interesting because if the One Big Beautiful Bill didn't pass, 2026 bonus depreciation was set to be at 20%. And now with the passage of the bill, it's back at 100%. So it's effectively 5 times more powerful now than what it would have been. And so a very significant welcome for our clients who have bought real estate after January 19th of last year, putting them in service. And that also applies for construction and rehab as well. So even if you have an existing property that you've owned years ago, but now you're doing rehab, you're adding ADUs onto them, all of the new improvements you do are eligible for the new bonus depreciation rules as well.
Nice. So how does bonus depreciation tie into like a strategy like cost segregation?
It is definitely a huge component of the cost segregation. So cost segregation is, for those people who don't know, we call it like a supercharged way of getting depreciation expense. With our rental properties, we can depreciate a residential house over 27 and a half years, a commercial building over 39. But with a cost seg study, which is basically like an engineering study, somebody goes in and looks at that building and says, hey, there's certain things in here that we can depreciate faster, like over 5 years or 15 years, which is great. That definitely helps. But then when you tack on bonus depreciation on top of it, those 5 and 15-year assets, instead of being written off over 5 or 15 years, now we can write it off on the first year. It's such a supercharged way of getting depreciation. So with a good cost seg study on a new asset acquisition, it's not uncommon to see upwards of 20 to 30% of the building amount be depreciated in the first year. So you could buy a $500,000 property, maybe it's $400,000 as a building. Take 30% of that, that's $120,000. That's your depreciation deduction in the first year. With a cost seg study, that's going to move the needle for a lot of people.
Yeah, and especially if you have multiple properties that you get that for too, right?
For sure.
What's in the rumor mill? What's the potential changes that are coming that you could see having a big impact for real estate investors?
Well, this is where we call Bruce. He predicts the future for us, and
yeah,
he's retired though. It's gotta be you guys.
No,
now.
He's not. No, I still have his number.
I think from a tax perspective, there's nothing major that is in the works at the moment, but I am of the opinion that if there are some significant changes to the economy that's when we may hear additional tax incentives come out to try to boost the economy. And, but as of today, there hasn't been anything significant that we're tracking for real estate purposes.
Do you guys like the 2025 big beautiful bill?
Yeah, I mean, purely from a tax perspective, right? Obviously, the big beautiful bill includes all kinds of non-tax things as well, but purely from a tax perspective, from the eye of a business owner and real estate investor, significantly beneficial, which was not a surprise, right? President's a real estate investor, so that part of it was very welcomed. I will say the one big beautiful bill is one of the recent bills that has pretty major changes outside of business and real estate too. So there were brand new tax benefits in terms of tax-free overtime, tax-free tip income. So those, brand new, and that those are good for working folks who, make W-2 income that traditionally had very little tax benefits. We have the ability to write off more on our primary home property taxes and state income taxes. That increased from $10,000 up to $40,000 for the threshold, and the ability to write off interest on a new personal vehicle assembled in the U.S. So a lot of different things that were positive from a tax savings perspective, even outside of the general real estate and business.
Yeah, and that's why I wanted to ask you about that, because there's a lot of political noise around it. But strictly from the tax and the real estate investor side, that's is it good for us? Then that's the answer that we want to hear, on at least on this podcast, right? So one of the things is knowing the law and understanding the law is one thing, but implementing it to be able to take advantage of it is a whole nother thing. And so can you talk to our people about being a real estate professional and that status and how that's advantageous for them?
Yeah, for sure. Real estate professional is definitely a great strategy to have in your toolbox, and to use it in the right way and at the right time. I think taking a step back for people to understand, kind of from a tax perspective, when you own rental real estate, you can always deduct rental expenses against rental income. But the question comes up is, if your rental expenses exceed your rental income and you have a loss, what do we do with that loss? Can I use it to offset my other income? In a general sense, the IRS says if you make less than $150,000 a year, you can deduct some components of current year rental losses against your income. But if your income is above $150,000, whether you're single or married, then in order to use rental losses to offset W-2, business income, interest, dividends, generally speaking, if you're investing in long-term rentals, you have to qualify as a real estate professional, or if you have a spouse, your spouse has to qualify. So that's the benefit of it, is it allows you to maybe strategically create those losses on paper through a cost segregation study, and then use those losses to reduce your taxable income from your W-2 and other sources. That's the benefit. But there are certainly some requirements you got to meet.
Yeah, I was going to say, I got a license. Am I a real estate professional now?
Yeah, I mean, usually for a real estate professional status, a couple of different roles. One is you have to, the first one I'll describe as the hardest one for most people to meet, which is you have to have more time in real estate than your job or non-real estate businesses. And so if I'm someone who works full-time at 2,100 hours in my job, I have to have more than 2,100 hours in real estate to be a real estate professional. So that's where we see the hurdle for if you are a high-income earner and you're in real estate, but if you have a job, it's difficult, if not impossible, to be a real estate professional. The other rule is you have to have at least 500 hours, generally speaking, on your rental properties. So that the tax term for this material participation, effectively you are involved in the day-to-day operations of your rental property. So what we see in practice is fairly difficult for somebody working full-time to qualify. However, there's what we call the marriage tax loophole, which is that if you're a high-income earner, but you have a spouse who's maybe only working part-time or not working, a stay-at-home, then that person, it would be much easier for that person to become a real estate professional because they don't have to overcome, job hours if they're not working. Then they just have to have at least 750 hours in real estate to be able to qualify as real estate professional.
So are your kids real estate professionals?
Well, that if your kids are real estate professionals, it doesn't actually help you on your tax return. It's going to be you or your spouse. But
But yes, we're going to turn them into them at some point.
But you better believe that we get a lot of questions all the time from married folks who say, "Hey, can you convince my spouse that I should stop working and be a real estate professional?" This is a daily occurrence, communication, text messages.
So we're in addition to CPAs, we're also marriage counselors. So.
Yes.
Career counselors.
Career counselors, is that what it's called?
Coach.
Yeah. We call that the marriage tax loophole, not the marriage loophole, because I've discovered there's no marriage loophole over the years.
Yes.
There's no.
Why would you be looking for it?
I'm not saying I was looking. I'm just saying there's no loophole.
All right, so we talked about one loophole. Is there such a thing as a short-term rental loophole?
Yeah, definitely. And so the reason it's called short-term rental loophole is unlike regular long-term rentals, where you have to effectively have more time in real estate than your job. If you invest in short-term rentals like Airbnbs, you are able to use tax losses that are strategically created to offset W-2 income, even though you still work full-time and real estate is just a side hustle. That's the reason it is termed a loophole, is because you don't have to quit a job and it can remain as a side hustle.
But it's certainly something that's written in the tax law, so it's not against the law. You're not going to go to jail. That's what I think a lot of people think of when they hear the word loophole, but it's a viable strategy that a lot of our clients use, and that's the reason they use it, because they can work full-time and they can get into real estate as a side hustle, still get the benefits to offset their taxable income right now, use that tax savings to continue to reinvest and build their wealth while still working, full-time theoretically. And so it's a way to kind of accomplish both goals.
Yeah, the way to be the way to utilize it is you do have to meet material participation hours. So it's not as easy as buy a short-term rental and there you go. Similar to real estate professional status, you have to be involved in the day-to-day operations of the rental property. And a couple of different ways to meet those requirements. One is if you and a spouse have at least 500 hours on the short-term rentals, then you qualify. It's as simple as that, 500 hours. If you have multiples, you can combine all of your hours together across multiple properties. If you're not able to meet 500 hours, another way to use the loophole is if you have at least 100 hours, but nobody else has more time than you. So that scenario would be, I have 120 hours, my cleaning crew only has 10, or my cleaning crew has 50, landscapers have 20. So none of those people have more hours than me. I can still utilize it. Okay. And then the third way is I have more hours than everybody else added together. So I have 30 hours, add everybody else up, they're only at 10. I can also use the loophole.
Okay. Somehow you only have 30 and they only had 10.
Yeah, but I just bought it.
Just bought it a day ago.
All right, so let's say I'm newer and I'm starting to get some success, and like now I'm starting to acquire a few properties. How early do you recommend that people start looking at creating entities?
I always tell people the earlier you can afford to do it, the better it is. We don't want to spend all of our money on entities where there's not enough funds to invest in real estate, of course, right? But to the extent that there is funds available, the sooner you consider entity structuring, the better it is, because when you have properties in your personal name, there's always the asset protection concern, right? Outside of insurance and things like that. And entity structuring is one of those things in the tax world where if you start out in the wrong entity, sometimes it is very costly or even impossible to unwind that mistake. So having the best advice you can afford sooner on structuring is always good, because it could have lasting implications when done incorrectly.
And protects you better too, right? So
yeah, for sure. It protects you earlier on and lets you sleep better at night.
That's going to do it for part 1 of our interview with Matt MacFarland and Amanda Han, managing partners of Keystone CPA. Be sure to tune in next week for part 2.
For more information on hard money loans, trust deed investing, and upcoming events with the Norris Group, check out thenorrisgroup.com. For more information on passive investing through the DBL Capital Real Estate Investment Fund, please visit dblcapital.com.
The Norris Group originates and services loans in California and Florida under the California DRE license 01219911, Florida Mortgage Lender license 1577, and NMLS license 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the hard money tab.